Today, we are going to discuss the impairment testing process for goodwill. I know, you're probably thinking, well, goodwill is what is essentially left over from a business combination. So, how do you test a residual and somewhat ambiguous number? That's a great question, and that's what we are going to answer today. Goodwill is a simple calculation. Once you've done the hard part and identified the total consideration transferred, as well as the fair value of identifiable net assets. But that's an entirely different module for a different day. Even though the calculation of goodwill is straightforward, there are other matters to consider when it comes to goodwill. And that is the subsequent accounting via impairment testing, which we will cover in this module. For instance, goodwill must be allocated to a company's reporting units at the time of acquisition. Impairment is tested at the reporting unit level, but the determination of reporting units involves some judgment and has been heavily scrutinized by the SEC for years. There are many factors that go into identifying reporting units and the related allocation of goodwill, so having supporting documentation and internal controls in place around these items is key. Additionally, the goodwill impairment test is required to be performed on an annual basis or more frequently if certain events occur that could potentially impair the value of goodwill. And determining whether these events have caused a reporting unit to be impaired requires a significant amount of judgment. When performing the impairment test, you will be required to use fair value measurements, which, as you know, also involves significant judgment and assumptions. So are you seeing a theme here? This residual goodwill number requires a lot of judgment when testing for impairment, and that impairment process can be heavily scrutinized. We need to make sure you're prepared. So let's get started.